Good morning, everyone. Thank you for joining us today. My name is Charlene Butler, and as Chair of Alberta's Automobile Insurance Rate Board, the AIRB, I am pleased to welcome you to our 2021 Annual Review Open Meeting. While we are not meeting in person, we have found that these virtual meetings allow us to conduct business the same as we would if we had a physical presence. In fact, we believe that we can reach a larger number of stakeholders for our annual review open meeting through this virtual format. During today's meeting, we will hear from stakeholders and receive their comments related to the review of Alberta's industry loss experience for private passenger vehicles. The AIRB respectfully acknowledges that we are situated on Treaty 6 territory, traditional lands of First Nations and Métis peoples. The AIRB's mission is to independently regulate automobile insurance rating programs and educate consumers to ensure that Albertans have access to a robust automobile insurance marketplace. Therefore, today's discussions are very important as they affect over 2.8 million drivers and the 45 insurance companies actively writing private passenger insurance in our province. Before we begin today's presentations, I would like to highlight a few housekeeping items. This meeting is being recorded to allow the AIRB to review the comments made by each presenter. The recording of today's meeting will be posted to our website prior to August 31st. A copy of today's agenda was emailed with the video conferencing details, so I hope that each of you have a copy. Copies of today's presentations and the written submissions will be available on our website, www.airb.alberta.ca, following this meeting. We have scheduled the meeting to run for approximately 2.5 hours. We will be taking a 15-minute break following the Facilities Association's presentation, and that should be at approximately 9:35 a.m. Alberta time. We kindly request that all presenters have their microphones muted when they are not speaking to minimize disruption and to ensure that all board members, presenters, and observers can clearly hear today's presentation. Under the Insurance Act and the Automobile Insurance Premium Regulations, the AIRB is required to conduct an annual review of automobile insurance trends and premiums related to basic coverage and additional coverage for private passenger vehicles. As part of this process, the AIRB is holding this open meeting to hear from stakeholders. We advertised this meeting on our website and issued a notice to all stakeholders in late June. The purpose of today's meeting is to receive input to assist the AIRB in analyzing industry experience in order to develop industry benchmarks that insurers and the AIRB will use in the development and review of rate filings after October 1st. According to legislation, the AIRB must consider industry-wide loss costs, administrative expenses, profitability, and any other matters that the AIRB considers appropriate. This meeting forms one piece of the process through which the AIRB will arrive at its industry benchmarks for rate filings, which will be posted to our website prior to October 1st, 2021. It's important to note that today's meeting will not address commercial coverage or complaints against insurance companies or the insurance industry. I would like to remind everyone that presenters and presentations that stray into matters beyond the mandate of the AIRB's review will be ruled out of order by myself, the chair, and you will be asked to refocus your presentation. Only those parties registered to present will have an opportunity to make a presentation today. Only members and representatives of the AIRB may ask questions of the presenters during the open meeting. Observers or other presenters will not be allowed to question the presenters. I also want to kindly acknowledge the receipt of written submissions from Aviva Canada Inc., the Cooperators Group Limited, and TD Insurance Group. The AIRB appreciates your contributions to our annual review, and we will consider the comments made in your submissions. Before we hear from our first presenter, I would now like to introduce each of our board members. Patricia Matthews, Vice Chair, Matthew Wazalowski, Consumer Representative, Jay Jaworski, public member, Jamie Hott, public member, and Joshua Gogo, public member. Sending his regrets today is Bill Moore, our other public member. Also sending his regrets today is the Superintendent of Insurance, Mark Bryson. Joining the board members today, we have Rajesh Sahasrabuddy and Chris Schneider with Oliver Wyman, our consulting actuary. Joining them for any questions is Paula Elliott. And also with us today are our very valuable AIRB staff members, Lori Belford, Executive Director, Kimberly Kern, Christine Zhao, Tracy Lemieux, and Hayden Borlas. We will now move on to agenda item number 2 and hear from our first presenter. I invite Raj Sahasrabuddy and Chris Schneider of Oliver Wyman, AIRB's consulting actuary, to present their report, Review of Industry Experience. This report was posted to the AIRB website on June 25th for review and comment by stakeholders at today's meeting. I will turn the presentation over to you.
Okay, thank you, Charlene. I will share my screen. Okay, did I successfully share my screen, part 1? Okay, great, thank you for that. Thank you again for the opportunity to present to the AIRB. Again, Chris Schneider and I, my colleague Chris Schneider and I will do the bulk of the presentation. Our team includes your longtime consultant, Paula Elliott, and she's available too, should there be any questions from the board that we need to discuss. So with that, okay, so our agenda for today's meeting will be similar to our prior presentations. There's several agenda items, but we'll be focusing on the investment income rate, loss trend rates, the effect of COVID-19 on automobile insurance, some recent reforms from 2020, and industry profitability. So in our first section, we'd like to review just some background and economic information, because that really does inform the environment in which the automobile insurance system operates. And it's important to understand that when evaluating trends and other factors within automobile insurance. Okay, so we develop the benchmarks that we're going to present today to support the AIRB's evaluation of rate filings, the measurement of industry performance, and the calculation of grid levels. Our analysis is based on aggregated insurance company data, and therefore it may not be appropriate for any individual insurance company, but it's more an evaluation of the experience of the industry as a whole. This is a presentation on our 2021 annual review, and that's based on data through December 2020. As you know, we prepare 2 reviews a year, one which we refer to as the semi-annual review, which is based on June 30th data. As Charlene noted, we issued our preliminary report in June, and we've reviewed the stakeholder comments on that report. And the stakeholder comments are certainly quite valuable to us to understand the industry's view of what they're seeing in the automobile insurance system. Just again, to briefly review review terminology that we'll be using today. You might see the abbreviation SAR. That's our abbreviation for semi-annual review. The most recent semi-annual review was prepared using data as of June 30th, 2020. Today, we're going to be reviewing the results of the annual review. As I noted, that's based on data as of December 31st, 2020. Coverages are, we present coverage, we group coverages into 2 categories. The basic coverages, which include third-party liability and accident benefits, and then additional coverages, which include comprehensive collision, and then specified perils, all perils, and underinsured motorists. Here we present the distribution of written premium and claims costs for between additional and basic coverages. Again, a reminder, the basic coverages are the liability and accident benefits coverages, and the additional coverages are more the first party coverages with comprehensive collision and the other smaller coverages. So you'll note that the distribution of written premium changed sort of very modestly from 63%, I'm sorry, from 60% to 63% for basic coverage, and from 40% to 37% for additional coverages. And we would expect that this is largely due to in COVID times where there was a little bit less driving, that potentially suspension of some of the additional coverages for drivers that were driving less to potentially save a little bit of money. The claim costs, however, have had a more significant shift in distribution. The basic coverage claim costs decreased from 67% to 59%. And obviously that was offset by a commensurate increase in the additional coverage claim costs from 33% to 41%. We think, or this is, as you might expect, largely driven by the COVID pandemic, in which the basic coverages essentially largely cover claims resulting from vehicles that are in motion. So you have to have an accident, and to have an accident, you generally have to be in motion, and you have to have a reason to go somewhere. And unfortunately, in 2020, we had fewer reasons to go to fewer places. The additional coverages are somewhat different. That they include comprehensive, which is really the primary reason for the increase. And a portion of comprehensive coverage is for stationary vehicles. And two of the notable perils that are covered there are theft. So obviously that's you generally don't see thefts of moving vehicles. So these are mostly stationary vehicles that were probably more stationary and potentially prone to a greater opportunity for theft. And there was also a hailstorm in Calgary as well in 2020, which is also covered under comprehensive. So we feel that both of those factors, while claim costs are down overall, the percentage of claim costs that are due to the additional coverages is increased from 2019 levels. Within the basic coverages, in this slide we show the breakdown between the three principal basic coverages: bodily injury, property damage, and accident benefits. You'll see that hasn't changed very significantly. But on the right side, the additional coverages, where you do see that the comprehensive coverage went from 41% to 62% of the overall additional coverage share. And similarly, collision, you see a decrease. And again, collision claims were caused by vehicles in motion, and fewer vehicles in motion during the pandemic. A few other items related to the background economic environment. The economic conditions, as you recognize, were severely affected in 2020 due to the pandemic, with much higher unemployment and much lower bond rates. And then gasoline prices also were much reduced due to lower demand. In this slide through June, we're starting to certainly see, and I'm sure you are on the ground as well, that the economy is starting to come back to life and get closer to pre-pandemic levels. We're still not there yet. The unemployment rate still remains a few points above the pre-pandemic levels, but certainly the gasoline prices have recovered and then some, really, from 2019 levels, relatively close to 2018 levels. And while bond rates are still low, that only represents one component of insurer portfolios of invested assets. And here's just a chart. You see the significant spike in the unemployment rate, and then it started to come down. So again, as we talk about 2020, we tend to refer to the whole year, but obviously there's varying effects of COVID throughout the year. The early part, no effect, then a severe effect when in the second quarter, and then the third and fourth quarter still affected, but probably less so than the second quarter. And here's a chart of the bond yields, so that you can see where they were at and how they've been reduced to inject money into the economy during the pandemic. Again, this is only one component of the portfolio, but it's important to recognize that insurer portfolios that include Government of Canada bonds will have resulted in less, will suffer in investment income as a result of these rate decreases. So with that, I'm going to turn it over to my colleague, Chris, to review the next section for rate filing benchmarks.
Great, thanks, Raj. Yeah, so over the next few slides here, I'm just going to be presenting the various benchmarks that are included in our annual report. So with that, I guess we'll just get started onto the next slide, Raj. Thank you. So the first benchmark that I'll be going over is the unallocated loss adjustment expenses. Insurers include provisions for loss adjustment expenses in their rate level calculation. For the analysis we perform, allocated loss adjustment expenses are included in the reported loss data, and we use the unallocated factors published in Giza's automobile insurance exhibit for the ULAE load. The 2020 factor for all automobiles is 10.3%, which is a slight decrease from the 2019 number, which was at 10.8%. Looking at this graph here, it just presents, the unallocated loss adjustment factor over time. We observed the Giza factors have been relatively stable over the last 10 or so years. However, there is some increasing going on since the low point of 2016. The 2019 factor is actually the highest ULE factor since 2009, the entire experience period that's presented here. And then, it increased until 2019, and then a slight drop off in the most recent period. Some of the variance in these observations may be explained by potential shifts between external and internal resources, which may cause some swings in the Giza factors and what expenses are going where or being allocated where. Our current catastrophe load benchmark is 51% and is based on industry experience through year end 2019. As Giza's 2020 CAT report was not available for our review. It just wasn't available at the time we conducted our preliminary report. Since then, it has been released, and we will update our benchmark, in our final review. Our 2019 benchmark or our prior benchmark, current benchmark, is based on a average of the 5 and 10 year averages of the industry CAT experience. If we apply a similar framework to the 2020 CAT report, which was recently released, we have an indication of 58%, so a slight increase. And this is primarily due to the the large CAT losses and the June 2020 hailstorm. So somewhat unsurprising. This benchmark is really provided to the board in order to give a perspective of the CAT provision of individual insurers and how it compares to the industry. The board should recognize that insurers' exposure to CATs greatly depends on each insurer's mix of business by location when they are reviewing the rate filings. So this slide hasn't actually been updated. Again, we just didn't have a chance to update it before we had to send the presentation over, unfortunately. So it's kind of the same as what was presented last year. The blue bars are the non-CAT losses here, and the gray bars are the CAT losses, and then the green line would be the ratio that we the observed ratio. The one thing I will say is the reported 2020 factor is 119%, and all the other factors are relatively consistent with the graphs that are presented here. And then 190% is what's driving that increase in the CAT provision that I had mentioned on the last slide. We did get some industry comments related to the CAT provision. Viva and IBC both believe a higher provision is warranted. citing the recent adverse experience in 2020 and also 2021. Aviva also recommended the board allow insurers to use their own cat load in rate filings. And then finally, TD has or was concerned about the recent influx of cat events and called for a climate change strategy to help develop future claim costs or reduce future claim costs. So the investment income rate, since July 2019, the board hasn't directed insurers to use their own, or has directed the insurers to use their own expected investment income rate. So we no longer provide a benchmark for the expected return. This rate should reduce the should reflect the expected return over the forecast horizon that the insurer expects to make. This change has generally been well received by the industry, and we didn't really receive any negative comments or anything like that in this year's stakeholder comments. Like Raj mentioned earlier, some of the expected returns may be a little bit lower due to COVID. So yeah, I think next slide, please, Raj. The Alberta Treasury Board and Finance has announced the 2021 health cost recovery assessment factor is 2.94%. The board has historically accepted this rate as the benchmark, and we update this factor annually. IBC, agreed that this was a reasonable provision, and there was no other objections related to this benchmark. The non-claim expenses, the board's position has been to accept the industry expense ratios reported by GISA as the benchmark for assessing the reasonableness of an insurer's expense provision. The current benchmark is 26%. And again, the GISA's 2020 expense report wasn't available at the time of the review, so the 26% is based on the 2019 expense report. Since then, the 2020 report has been updated, and we actually did make it into the slides this time, which is good. So, but the 2020 expense report also results in the same total expense provision at 26%. Although there have been some changes by expense component that we'll see on the next slide. The only stakeholder comment we got was from IBC, who continues to recommend an alternative approach in weighting all components by direct earned premium, and this results in a slightly higher expense ratio than the 26% that we propose. On this slide, we contains the breakdown of expense by category. As I mentioned, there are some small changes by component, but the total remains the same, 26% compared to our current benchmark. Most interestingly, we see contingent commissions have increased slightly. This may be related to the the favorable experience that was observed during 2020 because of the pandemic. And additional commissions paid out because of that favorable experience. We've seen similar, increases in contingent commissions across other provinces as well. So it's not just Alberta, but something to keep an eye on. And lastly, before I pass it back to Raj, here is the profit provision. The board's current position remains unchanged at a 7% profit provision. We didn't hear anything, no objections from the insurers or stakeholders on that profit provision. With that, I'll turn it back to Raj to go over the loss development factors.
All right, thank you. I did unmute myself correctly, right? Okay, good. So again, loss development factors are factors that we use to adjust. When I say we and I'll say the actuarial community uses to adjust losses from a reported basis to an ultimate basis. And as we present in our report, we develop these factors to develop the ultimate claim counts and the ultimate losses, and we're going to go through the through the results of that exercise. We do note that GISA has advised users to exercise caution for certain factors, we don't interpret the words or the suggestion to exercise caution as meaning that the data is completely unusable. It's really just a matter of understanding some of the uncertainties in the data. We do also review the development experience for the top 10 insurers, just to make sure that there's nothing odd about the data that would cause us to need to exclude one of those insurers from our loss development analysis. Various stakeholders did issue some certain comments related to essentially the results of the loss development exercise, which is the estimate of loss costs per vehicle over time. IBC indicated that their estimates were consistent with ours. The ATCLA expressed the view that ultimate losses have not materialized as expected, and that potentially that would indicate that reserve amounts would be too conservative or pessimistic, particularly for bodily injury back to 2015. And then other insurers that submitted comments generally stated agreement or did not comment on our ultimate loss amounts or development factors. And cooperators also indicated that it's important to monitor factors in the future because the effects of COVID-19 are unknown. So in the next several slides, we'll review the claim emergence for the basic coverages over time. So in these slides, the different components of ultimate claim amounts are presented in the different colors. So the IBNR, which is the uncertain portion that we project as actuaries, is in the darker red. And then the reported loss amounts are comprised of the paid amounts, which are a known and fixed quantity, and case reserves, which are developed by case adjusters on individual cases, which are also estimates of what the case might cost based on the information known at the time the case adjuster established the reserve. This slide is for bodily injury, and what you'll note is for 2013 through 2017, there were, over the past 3 years, there have been generally slight decreases in the loss trend rates, whereas for 2018 and 2019, we're seeing some slight deterioration. We expect more variability in the years on the right-hand side. You'll see there's more red and gray. Those are estimated portions. The blue is sort of a known fixed component, so that wouldn't change. But our view is that these changes that we see on these charts is consistent with what we would generally expect for coverage like bodily injury that can take some time until all the claims are closed and paid. We'll contrast this with coverages that's close and settle, where the claims close and settle much more quickly, like property damage. You'll see not in the next slide, but the slide after that. This is a slide of the ultimate count. So the prior slide was the total dollars. This slide shows the progression of the counts that are reported for bodily injury. And we do notice here that percentages are relatively small, but we do note a slight increase in the counts over time, and that would tend to indicate that there's maybe a little bit of later reporting of claims that include bodily injury claims associated with accidents. The property damage is again, you'll see the difference here, particularly on the left-hand side where the bars are entirely blue and claims are generally settled out, and you see a lot of consistency. And even on the right-hand side where there's still some development and there are still some open claims, it's still much more blue than what we saw on the bodily injury slides. Similarly, property damage counts have been relatively stable over time. And then now we have the accident benefits coverage, and I think there's a few aspects of this chart that we'd like to note. One is the increases over time, And you'll see this as we get into the analysis of trend rates, how the accident benefits trend rate is quite high. So you'll see the ultimate loss amounts are increasing over time. And then also within a year, generally you're seeing, although small, some slight increases from one valuation to the next. Again, that's not every year and every valuation, but there's a general upward pattern in both the estimates for a given year as claims emerge, and also across years. This is this is a slide with estimates of ultimate claim counts for accident benefits, and I think what you'll see here is that there's a lot more stability in the claim counts than there is in the ultimate losses. And again, we'll see that in the trends, which are mostly severity driven rather than frequency driven. Yeah, I'm going to turn it back to Chris to discuss COVID-19.
Thanks, Raj. Yeah, so COVID-19, this is where the fun really starts, I think. So as we saw on the graphs on the prior slides, Raj didn't necessarily point it out, but there was a big drop in the ultimate claim cost during 2020 for the majority of coverages. It's related to the decrease in traffic volume, reduction in frequency that is associated with that. We would expect COVID to continue to have an impact on claim costs until we have reached a point of stabilization after the pandemic is over. And therefore, insurers should reflect some kind of COVID-19 adjustment in their proposed rate programs. This adjustment can be thought of as a two-step process. The first step would be one to fully remove, or you could unwind the impact of the pandemic on the historical impact, historical data. And then the second step would be to apply an adjustment which considers the expected impact on COVID during the prospective rating program. Now, COVID is hopefully winding down, but there's a lot of uncertainty, and there just needs to be some kind of consideration of a potential impact. We received somewhat unsurprisingly, the stakeholders had a few things to say regarding COVID. Several insurers have implemented steps to provide relief to consumers during the pandemic. Most of the comments that we received from insurers were in agreement with our report and related to, one, the observed decrease in frequency across coverages. It was pretty apparent in their own data as well as the industry data. The decrease in, and a lot of them acknowledged the difficulty in forecasting, the end of the pandemic and what the future will look like, and when the new normal will begin. So there's a lot of uncertainty and a lot of difficulty with trying to figure out these projections. In general, insurers agreed that removing the 2020 data from consideration in selecting their trend rates and developing indications is an appropriate approach. Lastly, the ACTLA stated that the pandemic has resulted in significant one-time profits for insurers and profits for 2021 and 2022, potential profits for those years as well. We'll kind of talk about those profits later on at the end of the presentation. All right, so a lot of the analysis we do is related to the loss trend. It's a heavily debated topic. Our review, we consider severity, frequency, and loss cost trend patterns for each coverage. We use regression analysis and consider multiple combinations of parameters and time periods in an attempt to find what we consider to be the best model and best trend rate for the observed data. We evaluate the models using common statistics such as just R-squared values, p-values, and a visual inspection of how well the fit is to the data. As mentioned earlier, COVID-19 has resulted in that dramatic decline in frequency. during 2020 for multiple coverages, and we expect this to continue into 2021. However, our benchmark trend rates are intended to measure the rate of change in loss costs experienced without the influence of COVID-19. Therefore, we have excluded the 2020 experience from our models, where COVID has had a material impact on claim costs. And then if we can just go to the next slide, this slide will have a comparison between our recommended loss trends as of December 31st, 2020, our current recommendations in comparison to our prior. Since we're excluding the 2020 data in the majority of places, a lot of these benchmarks are consistent with our prior review. This generally should be the case anyway, but it's even more so true because of our approach. The only two coverages that have changed, we changed the trend rate was for collision, where we have seen some increase some slight increases in adverse development since our prior report. And then all perils we have reduced slightly because of some recent flattening in the data that we wanted to consider in our current selection. Lastly, our comprehensive trend rate has not been updated. It's dependent on the 2019 CAT data, and we will update that in our final report. Most stakeholders agreed or thought that our selections were reasonable, and projected claim costs will continue to increase over the next year. Specifically, IBC found our trend rates to be reasonable. Aviva, FA, Cooperators, and TD also agreed that in general, our own assessment of loss trend rates were consistent with theirs. However, there were a few exceptions, which we'll kind of get into over the next few slides. So each of our, we'll run through each coverage here, and each graph will look the same, or will be in the same format. These graphs include frequency, severity, and loss cost going down, one over the other. And then the left-hand side is a long-term view of the trend rates or the data over time for the last 20 years. And the right-hand side is just kind of like a zoomed-in view of the data since 2015 to kind of get a more recent view of the data. We also include the drop between 2019 2 and 2021, the first half or second half of 2020 and first half of the second half of 2019 and the first half of 2020 to gauge the impact COVID has had on the observed loss experience. So looking at the bottom left graph on this panel here, we see the loss cost data through time has, it's been increasing pretty rapidly since about 2010. And starting in 2017, there's this slight moderation. We find this is generally consistent with our selection of I think we have a +7 past trend rate and +5 future trend rate to account for that moderation. The COVID impact, it's going to be a very similar story from those coverages, but frequencies, large drop. I think the observed drop is 33.6% between the accident periods for frequency, and then there's an immaterial impact on severity. Similarly, for property damage, there's for pure premium, there's going to be just a combination of the two, frequency and severity decrease. So the stakeholder comments, this is bodily injuries where we got a few kind of disagreements with our selection. TD and Cooperators both suggested a slightly higher trend rate, while the ATCLA believes bodily injury costs have stabilized over the last 4 years and thought that our trend rate was too high. TD also reported that they continue to see erosion in the MIR through court interpretation, generally higher claim costs. So there's just some uncertainty and some different opinions there. Regarding the the property damage trend. Again, similar setup of what we're displaying on this graph. If we look at the loss cost trend on the bottom two panels, we see a slight upward trend rate, and we have selected a 1.5% trend, which same as the prior. We think that this is consistent with the observed data. The COVID impact is similar to bodily injury, but a little less so, a little smaller of a reduction, a 26% reduction in frequency, and an immaterial impact on severity when you consider seasonality in the data. And with that, I'm going to turn it back to Raj to finish off the rest of the coverages.
Okay, thank you, Chris. So I'm going to start with accident benefits, the last of the basic coverages, and then move into the additional coverages. So our selected trend for accident benefits recognizes the modest increase in frequency that you'll note, particularly in the chart on the right, where you see a slightly increasing trend. Again, keeping in mind that the very final 2 points are COVID affected. But in the middle graphs, you'll see there, and this is consistent with what we saw with the review of the ultimates, that the severity is really increasing at a quite high rate, even though the frequency is stable. And again, so severity is really the driver of the 11.5% trend that we're proposing. The effect of COVID, again, there's a pretty similar to what we saw with bodily injury, about a 37% reduction in frequency, and basically an immaterial effect in severity. And really what that means is that the estimates or the values for 2020 are consistent with what we expected the increases to be, because you might say that, is it immaterial? There's a 9% increase, but that really is consistent with what we're seeing in the years pre-COVID. Stakeholder comments. TD noted that they observe high loss trends consistent with ours, and again, I think there's obviously a concern when you have a double-digit trend rate. Collision. Less of an impact on severity. The collision trend rate is one of the ones that we modify, particularly on the bottom right chart in loss costs, that there's loss costs and severity are just increasing very slightly. And I just got a Zoom message saying my internet connection is slightly unstable, so hopefully it'll hang in there for the next few slides. Okay. Stakeholder comments. IBC indicated that there was concern that property damage and collision trend rates may increase as the economy rebounds and there's new car purchases. Of course, that'll create higher costs because new cars are more expensive to fix than older cars. Comprehensive. So what you really see here is, in the frequency, there's quite a bit of noise. You see there's a relatively large spike in 2011 due to the Slave Lake wildfire, and in 2016.
Raj, this is Charlene, the chair. We cannot hear you. Still,
Raj, maybe try to turn off your video.
Yeah, Raj, maybe try turning off your video and see if that stabilizes your connection so we can hear you. Still can't hear you.
I think he might be frozen.
I think he's frozen. Chris, can you take over?
Yes, I certainly can.
Thank you so much.
Sorry, one second. Let me.
All right, I'm sorry about that. Can you hear me now?
We can hear you now. Maybe Raj, maybe try turning off your video and see if that
Okay.
gives you some increased stability.
Yes.
But then can we still see your slides?
Yes. Okay.
Thank you.
So, so hopefully this will be a little bit better. And I'm in the office, so maybe our corporate finance department didn't pay our internet bill this month or something like that. So I'll have to see what's going on. But again, for comprehensive, I think what we see is that there's actually not much of a reduction in frequency, if anything. And some of that may be just due to the fact that the hailstorm in Calgary is masking any COVID effect. Again, and there is an increase in severity that temporary increase could certainly be due to the nature of the claims that came through with the hailstorm. Comprehensive theft. Again, there's a pattern of reduced thefts during slight reduction in thefts during the pandemic. We did, while there is some reduction, the theft levels are still much higher than the 2010 to 2015 period. And although we've updated these charts with the year-end 2020 data, we haven't updated our analysis because, again, as Chris mentioned, that we were waiting to incorporate the catastrophe data before updating that analysis. And we just received that catastrophe data report relatively recently. Okay, all perils. Again, so this is a smaller coverage. Again, I'm sorry, I forgot the comprehensive theft, the stakeholder comments. So again, I think generally most insurers are concerned about theft and are looking for either regulatory or consumer measures to try to lessen the effects of vehicle theft. Okay, all perils. So this is a coverage that has sort of a combination of collision and comprehensive coverages. So again, the hailstorm may be affecting this coverage slightly as well. But we had no change in our estimate of trend for all perils. Similarly for specified perils. The 2020 unaffected by the pandemic, but it does appear to be a slight moderation in trend. And again, there may be an impact due to the 2020 hailstorm. So I'm going to try to get it back to Chris because I'm getting a comment Zoom thing again where my connection's unstable. So underinsured motorists, again, this is a smaller coverage. There's no change in our selection. That's comprised of a 4% positive severity trend that you'll see, and just a lot of noise in the frequency data that we view as generally being flat. So with that, I'll turn it back to Chris to discuss reforms.
Great. Thanks, Raj. Hopefully your internet connection, kind of fixes itself. Otherwise, I can just kind of finish out the presentation. I know we're running a little short on time anyway, and we have a few slides to get through, so I'll try to get through them kind of quickly here. So in this section, I'm gonna kind of talk about the recent Bill 41 and the reforms. Overview of just a quick overview and recap of what's changed. The prejudgment interest paid on non-pecuniary damages now fluctuates with the current interest rates. There's been a change to the definition of what constitutes a minor injury, and dentists have been added as eligible health professionals for TMJ injuries. Also dentists and psychiatrists and occupational therapists are considered adjunct therapists with a $1,000 benefit net level. That's new. There were multiple changes to the accident benefit levels that went into effect. And then finally, there's going to be the introduction of DCPD, which is effective January 2020, which is a good time so far. On the next slide, we have just a brief summary of the changes to the accident benefit levels that went into effect in October of 2020. And everyone, I'm sure everyone's relatively familiar with these. Mostly increases kind of across the board, and that's pretty much it. So the stakeholder comments, generally everyone kind of agreed that it's too early to understand the actual impact of the reforms, and acknowledge that there's going to be additional time delay before the reforms have been realized in the data, and we can fully understand the effect of them. And this additional delay is kind of caused by the pandemic. If you kind of think about it, the 2020 data, we're already kind of throwing it out to a certain extent because it's heavily COVID impacted. We have 2021, which is going to be heavily COVID impacted. Who knows what's going to happen in 2022? So I know Raj is optimistic. I'm getting there. So hopefully, fingers crossed, we can start to get back to normal life, and also more importantly, measure the impact of the reform. Aviva, so we got some other comments. Aviva expressed their concern that Oliver Wyman's estimates may be too optimistic. TD notes a potential deterioration of severity for DCPD. They noted that some similar reforms in Nova Scotia resulted in a severity deterioration, and just pointed out that may happen here as well. IBC encouraged the board to continue moving forward with improvements to the province regulatory framework, and not wait until the full effect of the reform is hashed out. And then lastly, the ACTLA states Bill 41 has resulted in significant savings, both retroactively and prospectively. This slide, we had a comment kind of just saying that we didn't include our reform impact in our report. So we included it here just to summarize. These estimates were from our actually two different analyses we conducted in August and November of 2020. In total, we expect a total reduction of approximately 19% in bodily injury claim costs, and an increase of 7% in accident benefits claim costs as a result of the reforms. Again, we're not going to be able to, unfortunately, these are just initial estimates, and we're not going to really be able to re-estimate the actual impact until more data becomes available. So it's kind of just a waiting game here. I'll finish this off. Just a couple more slides. Profitability. If we go to the next slide, Raj. So this graph is a graph of the industry profitability over time. As we can see, historically it's been the industry's been at a deficit, but most recently the 2020 we were realizing some significant profits. I think the ACTLA also kind of pointed that out, and how that may continue into the future. So I think it's just something to kind of keep an eye on. And we can go to the next slide. So what's causing this profitability? Well, it's really a change in the loss ratios. There's a significant decrease in claim costs because there's a significant decrease in traffic volume and therefore frequency. So in the 2020, we see, if we just kind of look at the graph over time, multiple periods of high loss ratios, and all of a sudden it drops to 2020. And that's really caused by the pandemic. So that's kind of just what we wanted to point out is, once the pandemic is over, who knows, it's very possible that we could return to higher loss ratios again. And that's the last of our presentation here. I don't know if we have any time for questions, but certainly willing to answer any questions that anyone has.
And Charlene, well, thank you for the additional 5 minutes you gave us at the beginning. We used it all up. So,
Well, thank you. Thank you very much for the presentation. It wouldn't be a virtual meeting without some type of technology hiccup, and you did very well at transitioning and helping keep us on track. As the board has seen this information several times, we have no additional questions at this time. And thank you for your time. Have a great day, guys. Thank you so much.
Thank you.
Okay, we will now move on to industry stakeholder presentations to hear comments on Oliver Wyman's review of industry experience. Each presenter will have 20 minutes, including time to respond to questions that the board members may have. I will give you a warning when there is 8 minutes remaining so that you have a chance to wrap up and leave time for questions. So on to agenda item number 3, we have the Insurance Bureau of Canada, IBC. Joining us today to present are Aaron Sutherland, Vice President for Western Canada, and Hannah Beydoun, Director of Policy. Welcome. I turn the presentation over to you.
Thank you, Madam Chair, and thanks so much for having us today. Can everyone hear me okay? Can I just get a thumbs up? All right. If I do have tech problems, I'm glad I won't be the only one. I'd also just mention we do have Trevor Foster from IBC's Policy Department on the line as well, just in the event we get any fairly detailed questions. So I'm not clicking the slides through today, so you'll also hear me ask. Oh, I'm forgetting the individual's name who's doing that, but if I could just get us move to the next slide. So today we're going to talk a little bit about the state of the industry in Alberta, largely as it's informed by government's reforms of last year. Hannah, my colleague, is going to give us a bit of an overview of our perspective on the loss cost trends factors, which you all just heard quite a bit about. Our perspective on the grid framework, both the historical changes we're seeing there, or historical impacts we're seeing there, and then the specific changes from this year. A little discussion on the catastrophe provision, because we do think that's one area where the data that both Oliver Wyman and Deloitte were able to analyze was a little bit older, and we've certainly seen some fairly challenging catastrophe events in 2020 and again this year, which we think should be included in the AIRB's considerations. And then a recommended path forward this year for where we believe the AIRB should be focusing. And I do apologize, because this is going to be one of those presentations where we say one thing, then we say it again, and then we wrap up by saying it a third time. But I always learned that, say it 3 times over is how you kind of get your point across. So bear with us. So if I could go to the next slide. As you just heard and are all well aware, there were significant reforms introduced to Alberta's auto insurance system late last year that were designed to stabilize premiums and lower claims costs, while also enhancing care and treatment options for those injured in collisions. And of course, critically for the AIRB, there was also a vision within those reforms to improve the province's regulatory framework, reduce red tape, really with an aim to try to foster competition, innovation, and more consumer choice in the marketplace. And it's that third plank of those reforms that we should be guiding the AIRB's operations in the year ahead, because, and if we can go to the next slide, well, both Oliver Wyman and IBC's actuary Deloitte point to continued claims cost pressures. And because of that, we should be open to the possibility that further reform may be required or further cost control measures. The reality is that the reforms came in at the end of October, too little, and that means that too little data in Oliver Wyman and in Deloitte's analysis has been included to give us an accurate picture on the impact of those reforms and for any meaningful conclusions to be drawn. And of course, this isn't just IBC's position, and I'd ask if we could turn to the next slide. This was also noted by Oliver Wyman himself, who suggested that, unfortunately, based on the data that was available, it does not include, quote, sufficient claims experience to accurately measure the impact of those reforms. And of course, COVID only muddies the picture further. And so it's because of that uncertainty that we would suggest that in the year ahead, and you'll see this on the next slide, we should be focusing on, if we could just turn to the next slide, we should be focusing on improvements to the province's regulatory framework, specifically a move towards file and use, And I know our office has provided a recommended path forward there to the AIRB, and we'd welcome the opportunity to support your efforts in that regard. We also think and we welcome the AIRB's current consultation on Alberta's grid, because we believe that framework desperately needs to be returned to its original intent, which of course was originally envisioned to ensure new drivers had access to affordable entry-level premiums. Hannah's going to talk about this in a little bit more detail, but in recent years, the grid has grown far beyond that scope, and we do worry that the changes we're seeing this year to the grid, both in terms of the overall premium reductions there and then the relativity changes at either end of that framework, are only going to result in additional drivers being added to it, again, taking it further beyond its original intent. And, you know, every time another driver is added to the grid, that is another driver that safe drivers are forced to subsidize in their premiums. And we think that simply isn't fair. And we would strongly suggest that the grid be refocused to focus solely on new drivers, making sure they have affordable entry-level premiums and not necessarily high-risk drivers writ large. And then, of course, maybe I should just pause on the grid and also say that we do very much as an industry thank the AIRB for pulling forward grid changes this year in light of DCPD and all the other pieces underway. Having that earlier this year really is allowing the industry to bring forward a successful implementation of DCPD. We do know your offices had to change your priorities to facilitate that, and we very much thank you for it. And then the third thing we would just suggest is we need to continue to move towards a principles-based regulatory model. Generally, you know, we know that's been included in your own business plan, and we look forward to the opportunity to work with your offices on that. So that's sort of our suggested path forward. I'm going to turn it over now and for my colleague Hannah Beydoun to walk through a high-level analysis of IBC's perspective on the specific loss trends factors we've seen, and I'll get the presenter to turn to the next slide.
Great, thanks, Aaron. And if we could just move to the next slide as well. Great. Good morning, everyone. This year, we've retained Deloitte to conduct our parallel trend rate analysis. As you can see here, both actuaries are projecting steep one-year loss cost increases for bodily injury, accident benefits, and comprehensive coverages. What's worth noting here is that Oliver Wyman and Deloitte are projecting that under the current product, injury claims costs in particular will continue to rise much faster than the rate of inflation in Alberta, as we've outlined here in this table. These projected trends are very concerning for the industry, and they're suggesting that there remains pressure in the current system and may be pointing to signs for the need for further reform to Alberta's auto insurance system. But we do note that there's just too much uncertainty around the validity around these trend factors. With just 2 months of post-reform experience, there's just simply too little industry experience and data to truly understand the impact, and a matter that's been made more complicated by the temporary impact of the COVID-19 pandemic. Next slide, please. But one trend that we do think is going to play out is that for vehicle damage trend rates. Both actuaries projected modest vehicle damage trend rates of less than 3% each. However, we've seen much higher trend rates that have been projected in Ontario. In recent years, Ontario's drivers have purchased proportionally more new vehicles that are equipped with expensive collision avoidance technology than compared to Albertans. And while there are economic growth differences between the two provinces, as Alberta's economy recovers and drivers begin to replace their older vehicles with newer ones, we anticipate that vehicle damage costs will increase at rates that are far more pronounced than are currently being projected by both actuaries. And we suspect that it will exhibit a similar trend as that seen in Ontario. So I'll now pass it back to Aaron to introduce our position on the grid. So next slide, please.
Sorry, I did hit on this a little bit earlier, so I suggest just in the interest of time, so we have more time for conversations, Hannah, I'll let you dive right back into it. Really, our perspective on the grid, folks, is that it's bringing, because it's growing, it's bringing significant negative impact on safe drivers generally, as these folks are increasingly forced to subsidize more and more drivers as they're added to the grid. And we really believe that, you know, the process the AIRB has underway to explore improvements to the grid framework should focus on reforming its rules such that we can narrow the number of drivers that are on it and really try and get it back to its original intent of supporting new drivers with affordable entry-level premiums and not subsidizing premiums for high-risk drivers generally. But Hannah, I'll let you dive into the specific details there on the next slide.
Sure, thanks, Aaron. Thank you. So as Aaron said, the grid's current framework is penalizing safe drivers by forcing them to subsidize premiums for drivers that are higher risk by paying higher premiums themselves. And this is contrary to the grid's original intent, which we know is to secure affordable premiums for new drivers. However, over time, we've seen the grid expand far beyond the scope, leading to an increase in the grid vehicle population. So what we've seen is an increase from 5.2% in 2016 to 7.1% in the grid vehicle population. And this represents 50,000 new drivers being subsidized by Alberta's grid framework. And we worry that this increasing trend will continue to see more drivers on the grid, which is only going to further penalize Alberta's safe drivers. So next slide, please. So as you know, this year, an overall grid premium reduction was introduced of 31.9% to account for both the removal of DCPD from grid premiums and for the impact of 2020 reforms. But however, we think that the 11.4% reduction to account for the impact of reforms is just a bit too premature because those savings have yet to be realized for Alberta's drivers generally. And with the reductions to the grid differentials at both the lower and the higher end of grid steps, there was also no corresponding overall grid increase to offset this, or consideration of the historical underpricing that has existed for grid rated drivers. And unfortunately, this is likely to lead to an increase in the number of grid drivers, which means that Alberta's safe drivers will continue to be penalized to offset this further expansion of the grid. Next slide, please. Thank you. So it's more important now than ever that the grid be realigned with its original intent to ensure that new drivers have access to affordable entry-level premiums without hindering Alberta's safe drivers. If not replaced, we believe that improvements must be made to the existing grid framework to mitigate its negative impact on drivers generally, including a reduction in the number of grid stops and reforming grid rules around infractions and territories. So, and as you know, as Aaron said, we can speak on the grid, our position on the grid a lot more, but we look forward to working with the AIRB on improving the grid framework. So next slide, please. So just in the interest of time, I'll speak very briefly on the catastrophe provision. Oliver Wyman proposed a catastrophe provision of 51%, and Deloitte selected a higher provision of 55%. However, these selections were based on 2019 catastrophe data, and given that the available data does not include the considerable impact of significant severe weather events that we saw in 2020 in Alberta alone, and doesn't take into consideration the increasing trends in the province that we've seen with more severe weather events occurring, we recommend that a higher catastrophe provision be selected to consider the substantial losses from these catastrophic events. So I'm going to pause there and on this, but we'll take questions later at the end, but I'll pass it back to Aaron to summarize and outline our recommended path forward.
Thanks,
Great
Anna.
timing, because you're right at your 8 minutes, so doing excellent. Thank you so much.
Perfect. Well, as Laurie knows, I can speak at length on the grid and my thoughts there. I'm a bit of a Roman history nerd, so I'll just, and I wasn't going to say this, but now I've said it. I think IBC's perspective on the grid is just like Carthage, it should be destroyed. Because we just don't think it's doing its intent, and it's helping drivers generally. We do think something needs to be done for new drivers, but anyways, we've already talked too much about the grid. So you heard, I said at the top, we were going to say it once, Hannah was going to say it again. Now I'm here to say it one more time. So, you know, it's clear both actuaries suggested that continued cost pressures remain within the system. However, both certainly acknowledge that too little information is available to truly assess the impact that last year's reforms are having on the system. We do know that with regards to accident benefits, those costs were introduced right away, but the cost savings or reductions on the bodily injury trend line, those will take some time to understand, and that's a matter only made more challenged due to the COVID-19 pandemic and its lingering impacts on claims trends. And so, while we believe we need to have an open mind that further reform may be required, unfortunately today we simply don't know the extent to which that is the case. And if these reforms do end up being successful, a stable premium environment, we believe, presents an important opportunity for the AIRB to focus on its rate regulations objectives as envisioned in the 2020 reforms. And we believe that should be the focus of the AIRB's activities moving forward. And so on the next slide, or just think of what I said earlier. We believe, the AIRB should focus on continuing improvements to the province's rate regulation framework, which includes a move towards a true file and use system, and then also improvements to the province's filing guidelines generally. And to the extent that we at IBC or our industry can support with those efforts, we would welcome that opportunity. Did I mention the grid? We think the grid should be streamlined to return to its original intent. And then again, we believe that Alberta drivers would be well served by a move towards a principles-based regulatory model that better promotes competition in the market, promotes greater choice for drivers, but also, and importantly, provides the AIRB with the same level of oversight over rate setting and rates in the province, but just in a model that better facilitates competition and innovation. So yeah, that's essentially our perspective on what we saw this year. We very much welcome the opportunity to participate in this review. And so if we were at 8 and now maybe we're at 10, hopefully we have a good amount of time for some questions and conversation. And as you've probably figured out, I'm not the detailed guy. So if you recommend with those, Hannah's going to jump in there.
Great. Well, thank you, Aaron and Raj, or Aaron and Hannah. That's excellent. And as Aaron mentioned, Trevor Foster is also joined the team to answer any questions. So if we could get a grid view up here so I can see the board members and see if we have any questions. Sorry, I am not seeing the grid view. Hang on 1 second. There we go. Okay. Thank you very much. Any questions from the board members? Board members, if you could turn your videos on. Thank you. Jamie.
Good morning. Yeah, I have a question, and it's on slide 70 that what you had up. It was on actually slide 9 that's on the package that you sent us. But it's in reference to the vehicle damage cost as it relates to the age of the vehicle. And you're anticipating that that's going to drive costs more than what was seen in Ontario. So I guess 2 questions I have. Do you have data that would support that prediction? And then if that actually is reasonable, then what, if anything, can be done to mitigate that issue?
Yeah, no, I appreciate that. And it's a good question. So in terms of the data, well, maybe I'll flip it. So what can be done to mitigate it? I'm not sure there's a lot that can be done to mitigate it, because certainly addressing vehicle damage costs and the increased trends we've seen there of late, as cars are getting, more sophisticated, more computers, and they're simply getting more and more expensive to repair. So in terms of how you mitigate that from a regulatory standpoint, I think DCBD will help with some of that because it'll improve the efficiencies in the system. Beyond that, I'm not sure what regulatory improvements can be done there. And this is more one we wanted to ensure there a claims cost trend we think is underrepresented in the analysis, and wanted to make sure that the board was aware of, because while Oliver Wyman selected trends factors here around 1.5 or 2.5%, we know in Ontario those are closer to 9%, and we believe that's more indicative of where Alberta is likely to go moving forward, because while we have seen some economic challenges in Alberta of late, as the province is predicted to rebound ahead of many other Canadian provinces, and as that occurs, we do expect the take up of new vehicles to increase, and as more new vehicles enter our roadways, we would expect those trends to move more towards where they have moved in Ontario, and which is much higher than what the actuary had suggested. Of course, that's all predicated on them getting this chip shortage sorted out. Hannah, any other comments there?
Yeah, sure. And great question. Thanks for that. So just to answer your first part of the question on the data to back that up. So it's not actually higher. We're not projecting that it's going to be higher than Ontario, but StatsCan did show that Albertans have been purchasing less newer vehicles than in Ontario, but eventually they're going to need to replace those. So we suspect that there will be a similar trend to what we're seeing in Ontario. So to the data point, so actually it was last month, Oliver Wyman conducted a similar analysis to this for Ontario, and they projected a 9.2% increase in property damage and a 9.6% increase for collision trend rates. So eventually we suspect as Albertans are going to replace their new vehicles that those trend rates will increase in the coming years.
Great, thank you very much.
Well, thank you for that. You guys have done an exceptional job keeping us on time. And you have now used up your 20 minutes, but I thank the IBC team very much for coming to present. It's always great to hear from you. So have a great day, and thank you so much for joining and sharing your thoughts.
It was a pleasure to be here. Thank you for having us.
You're welcome.
Thank you so much, everyone.
Take
Bye-bye.
care. Okay, we are now on to agenda item number 4, and we welcome the Facility Association's representative, Saskia Matheson, President and CEO. I apologize there, Saskia. Philippe Gosling, VP Actuary and CRO, and Derek Tupling, VP of Government Relations and Communications. Welcome. I now turn the presentation over to you.
Thank you so much. We're very pleased to be here today. I'm just double checking in technology world that you can hear me and see me.
All good.
Okay, excellent. Sorry, I'm looking at the slide, so couldn't see you nodding, Charlene. I'm cognizant of the time constraint, as I understand also that you're having a break after this, and never want to stand between the board and a well-deserved break. So we're gonna stick to the timelines here. Facility Association always appreciates the opportunity to present to the board, to meet with the board and share information. We certainly see that as our primary responsibility. One of the things we want to mention is we always look at the perspective and the issues being addressed from our particular viewpoint, which is our requirement to guarantee availability of automobile insurance. And therefore, we take the position or look at the issues very much from a perspective of what does this do to availability in the market? How does it change the appetite or the market in general? And so we're going to talk about that today. And I know that DCPD is obviously a big topic of discussion, and we want to make sure that we leave some time for being able to have that conversation. I brought the team with me today. I'll be opening. Philippe Gosselin, our VP of Actuarial and Chief Risk Officer, will be speaking, but also to address any questions that you have, as I warned them all of the hard questions. We have joining us today Derek Tupling, our VP of Government Relations and Communications, Aidan Chen, who is our VP of Data and Analytics, and Fadia Charbin, our VP of Underwriting, Claims and Operations. So make sure you keep all the tough questions, please, for them. And if I can ask to move straight to slide number 4, we did want to talk very briefly about the strategic work that we went through last year. And really, a lot of these words will be familiar to those of you who've seen our mission and vision statements from before. The 2 areas that we really wanted to call out is this concept of locking in on our purpose, which is very much, although we want to be small in the market, we absolutely want to enhance market stability, but our primary legislative purpose will always be to ensure the availability of automobile insurance to owners, lessees, and licensed drivers. The reach out that comes from that, and you'll see showing up in this document, as well as very much the next, is the growing importance of data and data governance in what Facility Association is doing. And if I can ask to move to slide 5, which we refer to as either the nesting dolls or the eggs slide, where we wanted to really articulate how all of the growing areas, all of the related areas, really focus back on that concept of availability, from our Coke Classic farm providing policies through our servicing carriers, the risk sharing pools supporting market availability, And the newest feature in a very large and growing area of enabling market availability through accurate risk history data, which is the underwriting information plan that we've spoken about with the AIRB report. And of course, in this year of, particularly this year of changing product, IFRS 17, the concept of the importance of the reporting that we do. So that is our strategic. I'm going to keep that to there. More than happy to talk about this at length at any future time, but not today. So let's turn to slide number 6 if we can. I do like to show the market share of the different mechanisms together all in one slide. If you are looking at where are we going overall with the residual market, you see that we have, we're still happily never near where we were in 2004, where we started the adventure with grid and the risk share pools in Alberta. But we have absolutely begun, it seems, to inch back up, to climb back up in terms of that market share. And very much a larger market share in residual market reflects uncertainty of the players. That's very much the way I think you can take that overall picture, but it's often important to see how the pieces work together. I would also note this is private passenger. We'll come to our lament on commercial at a later time, but this is focused on private passenger. If you want to look at the component pieces, if we move to slide 7, what you'll see is the accounts that we've seen and the growth we've seen over the last few months. Now, I always remind myself, and Aidan's here, and he'll also remind me, not to be careful not to presume this is an overall number, but it doesn't necessarily translate into a common view of the people using the risk share pool. And these numbers from month to month can be very much affected by a single or two companies making a fundamental change in the way they use the pool. But I will say that over the last year with COVID, what we have seen is companies changing or trying to figure out their play in the risk share pool. Again, still reflecting the ongoing uncertainty in the market over what is likely to happen. If we put up slide 8, what you'll see is the written premium in the grid pool. And again, what you'll see is last year a drop, which very much reflected all of the consumer features, actions that companies and FA were taking in order to provide premium breaks to drivers. We're seeing a growth this year, but perhaps none more dramatic. If we scoot to slide 9, what you'll see, which is the non-grid pool, you really see the change. Early months of actually companies taking business back onto their books, and then companies putting business back in. And again, this is very different by different companies. And so there's a bit of, we see uncertainty, and seen as one of our jobs is to project the way these numbers are going to go for the rest of the year. Obviously, this kind of back and forth, like the same challenges you face in projecting as we move into 2022, creates some difficulties for facility association in projecting what is going to happen in the pools. And so I'm going to ask you again quickly to move to slide 10. And this I find, for me, a very interesting slide, because you see really the impact. That red dotted line is last year. So this is the non-grid pool. This is the business companies themselves felt they could not, they couldn't get the right rate for, and would they put it into the non-grid pool? So it's not hitting the grid. This is something they make a particular choice about. If you look at this year over last year, what we believe that we are seeing is companies facing the uncertainty of what is the DCPD going to do to the market? How is this going to influence us? And a number of companies are looking at their books and trying to probably de-risk by using the risk share pool to put in business that they really don't know, but what the impact of the reforms are, what the impact of DCPD is going to be. So I think as we talk about, and I hope we have the opportunity to have more conversation on this, DCPD is a very, and along with the other reforms, but really from a consumer perspective, from a universal perspective, it's obviously the widest impact. A quick look at slide 11 takes us to the, had to slide in our non-PPV. We know the focus of this meeting is PPV, but for FA, this remains a troubling part of our book. The farm area in Alberta is now in excess of 120 million. About a quarter of the business that FA writes across the country in the residual market mechanism is made up of Alberta non-PPV business. So it's the shifts you see over time have a lot to do with changing subclasses of business that come into the pool. It is not as dramatic as what we saw in 2019 and 2020, but it remains a large troubling area of our book and one we continue to focus on. With that, cognizant of the time, I'll ask to flip to slide 12, which is around the DCPD and particularly impact of the grid, which makes Alberta unique. And with that, I'm going to turn it over to Philippe Gosselin, our VP Actuarial and Chief Risk Officer, to speak about this issue. Thanks.
Thanks, Saskia. You're hearing me well?
Yes, all good for me.
Excellent. Thank you very much. So Saskia mentioned it previously, but there is an important change coming soon and that we should briefly discuss. And it is obviously the implementation of DCPD on January 1st, 2022. But before going over the uniqueness of Alberta with this implementation, and by that I mean the interaction with the grid system, we would like to acknowledge the introduction of DCPD in Alberta. Indeed, as stated on our slide, the introduction of DCPD means claimants are dealing primarily with their own chosen insurance provider, and costing of the system can be more precisely segmented. And also, DCPD does not change the overall cost in the system. DCPD only reallocates cost to higher rate group vehicles. This being said, we recognize that there is a short-term cost of changing this system, and this is the premium dislocation as DCPD is being rolled out. But again, we believe that in the long term, this is the right decision. The uniqueness in Alberta is the interaction of DCPD with the grid and also with the grid and the non-grid pools. By legal construction, DCPD forms part of the mandatory premium capped by the grid. FA support the decision to make DCPD equals to the market premium and therefore avoid a major cost increase in company system, which would necessarily have been translated to increase cost and price for Alberta consumer. If we go on slide 13, please. Now we should take a minute to discuss the impact of the implementation of DCPD on facility association business. So considering that almost 90% of the farm book is grid cap, that the farm business has less physical damage coverage, and the farm has more higher grid step risk compared with the industry, and that DCPD implementation has a larger impact on higher risk profile, DCPD will have a disproportionate impact on our book, on the farm book. But again, we would like to reiterate that FA supports the AIRB decision to place DCPD outside of the bracket of the calculation of the grid. And by that, I mean using the market premium or each company's premium, and adjust the grid cap proportionally to maintain the consumer protection. As mentioned previously, the introduction of DCPD will inevitably result in dislocation in premium. And that dislocation will impact the number of risks subject to the grid cap and consequently in the grid pool. But the construction chosen by AIRB ensures that the dislocation is limited to the introduction of DCPD and does not result in flipping of risk in and out of the grid and the non-grid pool. This is positive for the industry as well as for the consumer, as it avoids the ongoing confusion and cost of risk flipping in and out of the pools as vehicles are substitute or age or anything that would affect their DCPD premium. If we go on slide 14.
Philippe, it's the chair here, just letting you know you're down to about 6.5 minutes. Thank you so much. I didn't want to interrupt your.
Thank you, Madam Chair. Considering that there are many possible models for frequency, severity, and loss costs for each coverage that are valid and reasonable, and that the ultimate selection of model by insurers in developing their rate is a matter of judgment and interpretation that can differ among actuaries, even when modeling the same data, we don't intend to comment directly the benchmarks put forward by the Oliver Wyman report. However, we would like to reiterate our past, present, and future position regarding benchmarking exercise. Even though this position is well summarized on this slide, I think that it is important to go over it. So rate making is an exercise in predicting the future. All predictions are by definition estimate, and estimate can be incorrect. Annual review sets factors which we believe operate to construct a cap on rate level. And companies are always permitted to charge less than the file rate. So the annual review should allow company a range of reasonable factor. This is what we believe the benchmark exercise should be for. So on that, I'll pass it on to Saskia.
Thank you, Philippe. And I would say to the chair, you can read our conclusions. I would rather give you your those 4 minutes to, if there are any questions or areas we haven't talked about that you would like us to address today.
Thank you, Saskia, and thank you, Philip, for your presentation. Excellent information. And with respect to the stuff on DCPD, we will reach out for you and have a further discussion at another time, because it is something we'd really like to sit down and dig in with a little bit deeper. I also was interested in that your slides sort of compared this year to last year, 2 very unusual years. So it'll be interesting to see what happens going forward. Okay, if we could end the screen sharing, please, so that I can see the board and ask if we have any questions. Joshua Gogo.
Thank you, Chair. And thanks to Saskia and Philippe for the presentation. Saskia, as you put a lot of emphasis on the market share, risk pool market share slide. I was looking at it, and yes, you mentioned we're not anywhere near the 2004 levels. What I see, however, is the momentum trending up towards where we were, and I was scratching my head wondering, does the FA have, or is it working on an active strategy to at least reverse the trend, stabilize it, or reduce it?
If I can start, and I think that the others can jump in, where we take an active strategy to reduce market share is on the residual market portion, the farm rate, so private passenger and very much commercial. And I think if you looked at that site, you see we do worry about the market share in commercial. For the risk share pools themselves, there are limitations in the percentages that companies can choose. For grid, companies can put all grid business in, there is no limitation, and we do not actively attempt to reduce their use or convince them to do so. It is a capacity available to the industry where they have uncertainty about pricing. There is a built-in legal restriction on the amount that they can place into the non-grid pool. I would remind the AIRB that in January 2022, with the risk share pool harmonization across the country, that number is actually moving up in Alberta from 4% to 5%. And that's the restriction. No company can place more than 5. We have had companies in the past who've come close and hit that, and some have requested the capacity to go further. We've been very reluctant to ever allow a single company to get more, because that would allow them to, in some senses, take advantage. But the legal limitation is really where we focus our efforts.
Thank you.
Great, thank you so much for that. And again, thank you to the entire facility team. It's always an excellent presentation, and we enjoy hearing from you and the opportunity to share some learnings. So with that in mind, we will now take our 15-minute break. And actually, you've given us a minute extra even, facility. So well done, well done. You exceeded your expectations and ours. So
we always try.
I know you do. Thank you. And we do appreciate it.
Thanks.
So everyone will take 15 minutes, refresh our beverages, stretch your legs, and we'll start our next presentation at 9:50 Alberta time. Take care.
Thank you.
Well, welcome back to those of you returning, and welcome to any of the observers who may have just joined us to hear from our industry stakeholders at this time. Just a reminder that I would ask that all of the board members have their videos on for the duration of the meeting. Please keep your video on so that I can see you when we go to the question periods, and so just leave it on for the rest of the meeting. Thank you. We are now on agenda item number 5, and we will hear from the AIRB's consumer representative, Matthew Wesolowski. He will share the consumer's perspectives that he has collected for this annual review. Thanks, Matthew. The floor is yours.
Excellent. Thank you very much. First, just a small little bit about the role of the consumer representative. If we can go to the next slide, please. There we are. So the consumer representative is a position that's actually created pursuant to the Insurance Act, and it's appointed and reports to the President of the Treasury Board and the Minister of Finance. And my role as a consumer representative is to engage with Albertans on issues that are relevant to them pertaining to automobile insurance, and to ensure that Albertans have a voice and are represented both in the annual review and in the rate making and in the rate review process. If I could have the next slide, please. So to do that, guiding principles were established for the AIRB to meet consumers' expectations. And the 4 guiding principles that we work with are affordability, stability, accessibility, and customer service. If I could have the next slide, please. So a big part of the role of the consumer representative is to connect with consumers. And in this past year, we did that in 2 ways. One was through a consumer perception survey that was done both via social media and via a telephone survey. We also held virtual focus groups this year, of course, because of COVID, the pandemic. The typical focus groups that we would hold in person weren't possible, so we moved into the digital world, and I would say the virtual focus groups were quite successful. If I could have the next slide, please. So this year, as I mentioned, we did a consumer perception survey, and this year we reached out to and touched more than 1,100 individuals, and this was the largest perception survey that's been done by the consumer representative. And you can see by the slide that the representation during the survey process was very good. We were pretty much 50-50 male-female. We wanted to make sure that we had accurate representation across the age groups, and we're just about 1/3 in each sort of age group. And you can see that we also created sort of a good representation across the years that individuals were licensed. So I think we did have indeed a good representative sample this year. We could go to the next slide, please. Now, this is where it gets pretty interesting from my perspective. When assessing automobile insurance premiums, we were asking consumers how much they agree with the statement that automobile insurance premiums are fair and reasonable. And you can see there's a dramatic shift from 2018 to 2021. Back in 2018, we had about 25% of individuals who had really low agreement with the statement that it was fair and reasonable, and we had much higher agreement. As we progress through to 2021, that number has shifted from 25% with low agreement on that statement to 75%. So as we went through the process, we can certainly see that consumers are becoming unhappy with what they're paying for insurance, and they're not seeing the prices presently as fair and reasonable. And so this is a significant change in perception that we need to address going forward. If I could have the next slide, please. So the average change in automobile insurance premiums is represented by the bar graph. And you can see that we've consistently had increases in premiums in Alberta from 2012 to 2020. But it's important to note that a number of those years are increases that one would expect relative to inflation, relative to increasing costs. But certainly as we went through 2018, 19, and 20, we saw larger increases above 5%. And I think this is indicative of why consumers are becoming more price sensitive and more concerned about pricing. But I think it's also important to say that insurance and pricing is cyclical. Premiums have gone through periods of time where they're increasing, and they go through periods of time where there's stability or even slight decreases. And in the last year, we have seen that COVID, as we've seen from some of the other presentations, COVID-19 has had a dramatic impact on the claims experiences and the amount people have been driving. And we're also seeing that there's a number of reforms that have been instituted recently. And so certainly one would hope that as we move forward, there'll be greater stability in overall pricing. But again, this is something we have to keep our eye on, given our guiding principles. If we could move to the next slide, please. When we look at pricing of insurance, it's really important, I believe, to put it in context, because we live in a diverse country, and from coast to coast, if we look at the insurance rates, we can see that Alberta is pretty much in the middle of affordability when it comes to insurance. So this is a representation of the average automobile insurance premium as a percentage of individual after-tax income. And while this is based on 2019 data, it's still very reflective of where we're at. And if we went back to 2018 data, we only moved up by 0.1%. So previously it was 3.0, and right now it's 3.1%. And as I said, if you look at the high in Ontario of 4% and the low in Quebec 2.1%, we're kind of in the middle there in terms of affordability of insurance. If I could have the next slide, please. So one of the things that is of interest to us is whether the consumers are aware of the factors that contribute to rising premiums. And this is relatively new data that we started collecting. So you'll see that we only have data points for 2020 and 2021. And as we look at it, there are a number of items that are addressed, such as severe weather events, distracted driving, cost of injuries from vehicles, expensive repairs to automobiles, and theft in the province. What What I found interesting from this was that in each case from 2020 to 2021, the consumer's stated knowledge of these factors that can impact increases to insurance has decreased. So their stated knowledge has decreased. Now, that's something I want to look at and say, why is that happening? And is that because simply 2 years don't make a trend? It could be that even though we have a representative sample, it's a small sample when you look at the overall population of drivers in Alberta. And is it the fact that you ask different people the same question, you get different answers? Or is it because there was less of a focus on the cost of insurance, less information, less education of drivers, and some of the knowledge has just simply been forgotten? So something we need to look at. If I can have the next slide, please. One of the things, though, that was interesting is that when we talked to consumers about what actions they could take to reduce their premiums, their knowledge seemed to be fairly good. And again, this is a new question that we asked this year, but you can see that people are quite aware that if they decrease their coverage or bundle their insurance policies within the same company, or if they do some shopping around or inquire about discounts, all of these things could reduce their overall premiums if that was their goal or their objective was to reduce premiums. And you can see there's fairly high knowledge there amongst people about what they can do. If I can have the next slide, please. So this slide is very representative of what we started talking about, which is that rising prices in Alberta have been a concern for consumers. That was sort of the number one thing on their mind. And I've always believed, and I'll quote Rachel Maddow, a newscaster in the States, she always says, look at what people do and not what they say. And if you look at the number of people who are shopping the market, the number of people who have gone out to get competitive quotes in the last couple of years, you can see that people who are shopping the market has increased dramatically from 2018 to 2021. And obviously the corresponding side of that is the people shopping the market who say they did not shop the market is decreasing. So what we can see is that not only are people saying that pricing is a concern for them, they're out there shopping the market and they're looking for a better price. And so we need to explore this further as we go forward and make sure that people are aware of the factors that go into the pricing, and that they're aware of how they can reduce their insurance or what they need to do for insurance, and how best to shop the market for insurance. And one of the things that I would say is that this is something that the AIRB encourages to all consumers, is if one is concerned about their rates, that one should shop the market, because people can at times find rates that are more suitable to their needs by shopping the market. If we can have next slide, please. Also, when it comes to customer service, one of the concerns that we need to address is if an individual has a concern, can they get the answer that they need to satisfy the questions that they're asking? And so again, over 2020 and 2021, you can see that more and more individuals are contacting their agents or their brokers to get answers as to why their premiums are increasing. And we see a slight increase from 2020 at 73% up to 79% in 2021. And that's, I guess, to be expected as people are concerned about pricing. But you can also see from that slide that people believe that they're less satisfied or are getting less satisfaction from their agent or their broker when they ask the question. And that's something I think is very important, is that our industry professionals need to be able to answer the questions of the consumer and explain to them fairly and reasonably why the pricing is the way the pricing is, and if there's increases, why that is, or if there's specific things in that individual's own history that have caused premium increases, so that they understand that. So I think some work needs to be done in this area. If we could have the next slide, please.
Hi, Matthew, you've got about 7 minutes left. Doing great. Thank you.
All right, thank you. So COVID-19, we've heard a lot about that today. I just want to touch on it briefly. We did ask consumers a new question, and we said, do you agree that the pandemic, during the pandemic, you were able or had the opportunity to have your premiums adequately adjusted to accommodate your driving habits? And certainly 22% said yes. And I think that this would be reflective of the number of people working from home or those driving less, particularly during lockdowns. Of course, there were a number of individuals who were essential services or had to continue working, and they wouldn't have seen the same reduction in premium. This is provided for information. If I could go to the next slide, please. You know, insurance is always evolving, and in past years, we've talked a bit about user-based insurance. And I just want to point out that it's interesting, if we look from 2018 to 2021, there is a decrease of 19% in those individuals who said they'd be interested in considering user-based insurance. There's really no change in those individuals who said no, but the group who says it depends, or those who are undecided, has gone up quite a bit. And you know, for me, that makes me ask the question, why? Is it a product issue? Is it a public acceptance issue? Is it education, or is it something else? And something further that I think that both ourselves and the industry will need to look at and question. If I can have the next slide, please. So when looking at UBI, it was previously only to earn discounts on your policy. But as the product is evolving, some insurers are certainly considering additional charges for bad driving behavior. So we asked a new question, where our question was, would your answer to the previous question change if you knew you would pay more if you demonstrated unsafe driving behavior? And of interest, 34% said yes, and 47% said no. So I think, again, this is all information that will have to be taken into consideration as this product evolves. If I go to the next slide, please. So in addition to doing the consumer perception surveys, we had 4 focus groups this year. And just a couple of key points that came out of those focus groups. There was a higher agreement in the focus group discussions with the statement that automobile insurance premiums are fair and reasonable than in the survey results. And when I thought about why, I think it's because during our focus groups, we did ask them to put into consideration the cost of insurance in context to other monthly expenses, such as their cell phone, internet, or utility bills. And when people thought of it, they were more likely to say that their premiums were fair and reasonable. We did see that consumers are asking for less industry-specific language, increase in transparency, and they're also looking for less burden when they shop the market. They want it to be easier when they go out to shop the market. There is some support for user-based insurance, as I said, but some people have concerns about that. And a lot of those concerns were around privacy and how the data would be used. And then last point on this slide, consistently across all the focus groups, one of the main things we heard from people was they thought there should be higher penalties and more enforcement distracted drivers. If I could go to the next slide, please. So overall, a few observations from the work we've done over the last year. Many consumers are experiencing, as I've said, unexpected increases in premiums despite having no claims or convictions. The majority of consumers do not feel that their premiums are fair and reasonable, and that this has led to frustration for a number of consumers. And frustration in that they don't like the increases and they don't understand the increases. And more consumers are shopping the market, and as I said, encouraged to do so by the AIRB. And consumers find insurance to be complex. It's a complex product and would be more appreciative of more online resources to help explain it. And so with that, that would be my observations for the work we've done this year as a consumer representative. And thank you. That's the end of my presentation.
Thank you very much, Matthew. It's always great information, and it's such a critical part of the role of the AIRB, and we really appreciate it. Thank you so much. Okay, as we've had plenty of time to discuss the consumers report in our other board meetings, we won't be entertaining questions at this time, but thanks again, Matthew. Agenda item number 6, and our final presentation for the day, is the Alberta Civil Trial Lawyers Association. Joining us to present today are Owen Lewis, ACTLA Judicial District Representative for Grande Prairie, and Craig Allen, Independent Consulting Actuary. Welcome, gentlemen, and I will turn the presentation over to you.
Thank you, Madam Chair. First of all, I want to make sure that I'm coming in clearly and I don't experience the technical difficulties that I'm sure I'll experience at some point.
Looking great, Owen. Thank you.
Thank you. So as mentioned, appreciate the opportunity to present before you here today. I will be conducting the presentation, but we do have our independent consulting actuary, Craig Allen, who's joined us and would be able to answer any questions that you have of a technical nature. I won't be controlling these slideshows, so unfortunately you'll have to deal with me saying next slide, please. So if we could move to that. So our recommendations, and I appreciate that the AIRB has had the opportunity to review the information that was provided by ACLA, and also that Oliver Wyman has been able to comment on some of the information that we provided in our written materials. But in brief, our submission and recommendation is there should not be rate increases to premiums for private passenger vehicles in 2021. And there's a confluence of factors, obviously, that we point to indicate that this should be the case. The first is the information which would suggest that the bodily injury claims costs and claims for all coverages have essentially stabilized when adjusted for inflation since 2016. While that's been occurring, the consumer premiums, as has been indicated, have been increasing since 2016. We also have the effects of COVID-19, and everybody has kind of commented on that. And I appreciate a once-in-a-lifetime pandemic is something which is going to create some issues for actuaries when they're using the numbers of previous years. But we know that COVID-19 has happened, and we know that it has certain impacts that are going to be felt going forward. Additionally, Bill 41, the reforms which were already discussed that were brought in November 2020 have resulted in savings both retroactively but also prospectively. And those are savings which were unexpected and certainly not ones which the AIRB would have considered in any of their past rate increases with respect to the benchmarks. And finally, dealing with the pre-tax profits of the insurance companies, and this was commented on by Oliver Wyman in terms of the fact that there certainly are increased profits which have occurred as a result of COVID-19 and the other factors mentioned above. It was the first time that I saw their slide presentation, but what I was able to glean from it was that the profits were over 20%, I believe, is what the graph showed in 2020, and we'll have a little bit more information on that. So next slide, please. As we've presented in the past to the AIRB, our position is that the bodily injury claims costs have actually stabilized, and we've seen a stabilization of that, which has occurred since 2016. When looking at Oliver Wyman's reviews, and these are past reviews, not necessarily the current one that was before, but they did show in the 2020 semi-annual review that there was stabilization. Bear in mind as well that all of the graphs that we use are indexed to inflation. So we do use 2016 dollars. The information which is provided by Oliver Wyman is not indexed to inflation, and we certainly understand why that occurs. But what we want to do is simply show that there are not skyrocketing bodily injury claims costs in relation when it's stabilized and everything is looked at in terms of 2016 dollars adjusted for inflation. As well, the GIZA June 2020 actual loss ratio, as at December 2019, and this was from Ernst & Young, who prepared the GIZA data, again showed the stabilization with respect to bodily injury claims costs. If we can move to the next slide, please. Now, in terms of how actuaries approach this, and I'm not an actuary, so I would allow them to speak, but they're looking at a number of different factors to come up with projections moving forward. But what's quite interesting is the fact that a lot of the current data is really just reserve practices and looking at how the insurance companies have reserved for bodily injury claims costs. And this graph shows what I found to be quite interesting information. In terms of 2016, when you look at the fact that 95% of the claims are closed, but only 58% of the dollars are paid, there's still an awful lot there which is being reserved. Now, nowhere near what we see for the reserve practices in 2019 and 2020, when you have a much lower claims count that has actually closed. But even 2019, you see 57% of the claims have been closed, but only 9% of the dollars have been paid. So when we're looking at these recent years, we're really dealing with what are the reserves that are set out. And when we talk about the reserves, we need to be mindful of the reserve practices of the companies. And that's where we comment on the cautions which are put forward in the GIZA documentation, that since 2017, one of the large providers in Alberta have changed their reserve practices. Now, I don't want to spend too much time on this because I want to leave it open for questions, but the details of that are included in Craig Allen's report, and it's set out in terms of the reasons why we believe that some of the data, and when you're looking forward, you need to look at some of the past data to say, okay, the reserve practices need to be considered, the change that occurred in 2017, but also the fact that the projections for the reserves actually haven't turned out to be nearly as bad when you look at the 2015-2016 years as what was anticipated. If we can move to the next slide, please. So notwithstanding all of what we believe should be the numbers, when you look at all coverages for the ultimate loss and the cost per vehicle based on the Oliver Wyman review, adjusted for inflation, you see the stability between 2016 and 2019, and of course the drop that occurred due to COVID in 2020. That's a leveling off. That's a per vehicle, what is being paid out on those claims, which includes the reserves which have been set for those, which, as we've pointed out, we believe are a little bit lower. And when reasonable and appropriate adjustments are made, as Mr. Allen has done, it does show, with respect to bodily injury loss costs, that stability. If we can move to the next slide, please. So at the same point in time that we've had that stability in terms of the claims costs that have been paid out, we have seen the past trend rates from Oliver Wyman and the increases which have occurred with premiums. So I appreciate that these are the benchmarks which have been allowed by the AIRB in the past in relation. But we have those increases then with respect to premiums, but we have the stabilization in terms of what's been paid out. And of course, that simply leads to profits. It either leads to one of two things. Down the road, it's going to lead to decreased premiums, or it's going to lead to increased profits. As we'll see at the end of this slide, it certainly led to increased profits in relation to the last couple of years, and certainly the projections with respect to 2021, taking that matter into account. We could move to the next slide, please. COVID-19. Obviously, a lot of discussion about that, and I appreciate that Oliver Wyman has said, given the unique circumstances of COVID-19, we're not going to consider it when we look at our projections moving forward. Our position is COVID-19 happened. When the benchmark rates were increased in 2019 and 2020, they were increased on the basis that, yes, those claims costs would increase year over year. That didn't happen. Now, as I mentioned before, I appreciate it's a unique situation. And Oliver Wyman has said that it should be taken into account by the AIRB when considering. And that's something that we suggest needs to be taken into account. And really, when you look at it, COVID-19 happened. Would it be the worst thing in the world to say, okay, considering that, we take a break on any rate increases for the year moving forward, taking that into account? So we've got the situation which we know for 2020. We have the uncertainties with respect to how that's going to impact 2021 and 2022. But certainly, even anecdotally, we can tell that in 2021, the driving has still been down from what we would have seen pre-COVID. J.S. Chang and partners in the May 27th report proposed a claims cost reduction of 5% for 2021 and a smaller reduction of 2.5% for 2022. Again, that's not been factored into the Oliver Wyman report, and we feel there needs to be some consideration of that, at least as it relates to the year which occurred and 2021 moving forward. So if we can move to the next slide, please. In addition to COVID, we've had the passage of Bill 41, which resulted in numerous changes. And I appreciate that Oliver Wyman in their supplementary presentation today indicated that with the changes in Bill 41 that they've identified, they saw, I believe, what they indicated to be a 19% decrease in bodily injury claims costs. We've taken the information that the IBC provided in terms of what the anticipated savings for the insurance industry would be in relation to two specific measures in Bill 41. One is the prejudgment interest, which has been changed from 4% on general damages to floating. That was anticipated by the IBC to result in savings of over $40 million a year. And then also the definition change to minor injury, which will result in savings of approximately $215 million a year. Again, this is information from IBC, from their driving change, not necessarily what we've come up with independently. What did occur is there's retroactive savings with respect to prejudgment interest, given the position that was taken by the superintendent of insurance, that provision would apply retroactively. Again, those are savings which aren't necessarily reflected in any reserving practices of the insurance companies, nor are they reflected in the Oliver Wyman analysis. So those savings are measurable, and some we know are going to apply retroactively and others prospectively. Oliver Wyman has indicated that they haven't taken that into account, and I appreciate as well the comments from IBC that they should be factored in. And we simply encourage the AIRB when they are considering the benchmarks to factor in the known effects as well as the anticipated effects. If we could move to the next slide, please.
Owen, it's your friendly chair here, just reminding you down about 7 minutes, but you're doing great. Thank you.
Perfect. Thank you. Finally, given all of the above, the stabilization in claims payouts, the increase in premiums, the effects of COVID-19, and the retroactive effect of Bill 41 leads to profitability for the insurance companies. In terms of the actual for 2020, and again, there's different ways to adjust for this. We haven't seen anything necessarily from the insurance industry specifically, but taking the data and projecting it forward, as Craig Allen has done, the total profits pre-tax, including the retroactive effects of Bill 41 for 2020, was higher than we previously predicted. We thought that there'd be profits of approximately $750 million in relation simply to automobile insurance in Alberta. That number is actually higher, just under $1 billion when you look at it from that. And the projected for 2021, which only takes into account a 5% reduction. Whether that 5% comes to pass, whether it's higher or lower, we don't know. But again, the projected profit's quite significant. So if we can move to the next slide. So in conclusion, our position on behalf of the Alberta Civil Trial Lawyers Association is there should be no rate increases for 2021. We appreciate that this is simply with respect to benchmarks and that individual insurance companies will have to come before and justify any rate increases that they're requesting. But we've had a number of factors which we think need to be taken into account by the board when making that determination. And our suggestion is for this year that the benchmarks reflect no increase. Certainly open to questions, and I'm glad that I allowed a little bit of time this time as opposed to last year to address any questions you might have.
Thank you, Owen. You actually get through an amazing amount of type in record time and very, very clearly spoken. I really appreciate your final comment there, Owen, and the reminder that what we're talking about today is benchmarks, and that the rate board really does look at individual companies when they come to us, and that those benchmarks are not necessarily anywhere near what we actually approve on an individual company basis. So I appreciate that. Also appreciate you sharing your presentation with us today and providing the written report. We do not really have any specific questions for you here today, but I would like to remind you that last year I recommended that you perhaps sit down with our staff to ensure a common understanding of our rate approval process. And I reiterate that that offer still stands. And I really hope that you will take the time to meet with our staff. But I would like to thank the ACTLA for your time today and for your presentation. Thank you very much.
Thank you.
We have now concluded today's presentations. On behalf of the AIRB board members and staff, I would like to extend our thanks to everyone in attendance. We appreciate the participation of those who took the time to provide written submissions and make presentations today. Input from stakeholders is an important component of the annual review process, and all feedback and comments are welcomed and appreciated. The AIRB will consider the information received from today's presentations, as well as the written submissions, as it deliberates the setting of industry benchmarks, which will be used for our review of insurer rate filings effective October 1st, 2021. The benchmarks are used in the review of rate filings, and insurer-specific data is compared to the industry benchmarks. Insurers are expected to use their own data where credible. Where an insurer's results are significantly different from the industry standards, we will seek additional information to support and understand the variances. We will now consult with our actuaries, Oliver Wyman, to determine if any additional information is required to finalize our 2021 annual review report, which will be posted to our website no later than September 30th, 2021. The stakeholder presentations will be posted to our website, www.airb.alberta.ca, following today's meeting. A recording of this meeting will also be available on our website no later than August 31st. Again, I would like to thank each of the presenters for assisting us in gathering information and data to support our decisions with respect to the industry benchmarks. I would also like to thank those that took the time to observe today's meeting, and I would like to extend a thanks to NCOR for their assistance in running today's meeting. This meeting is now adjourned. Thank you.